With central banks accumulating gold reserves at unprecedented levels, what signals are they responding to, and how should family offices interpret that behavior for their own portfolios?
Yeah, look, it's good. It's a good question, and firstly, I'm honoured to be stepping up next after Rick Rule, who's a legend of the gold industry. But look, to be clear, Angelo, I just want to correct you on one point there. You talked about all central banks accumulating gold. That's not quite correct. Not all central banks are accumulating gold reserves today. Generally speaking, it's the Eastern central banks. And this is such an important point that I want to make to you and the listeners, that the theme throughout our interview today is about the power moving from west to east. Okay, so today what we see, and you got to look at the official gold holdings, and that is that it is the Eastern central banks that are acquiring gold at a very, very fast rate today. So China, Russia, India, Brazil, Turkey, okay, just to name a few. I mean, there are some in the West, to be clear, right? But the majority of the central banks that are buying gold today are Eastern central banks. So power from west to east. And I think the context is really, really important here. So if you go back to 1980, 74% of central banks' balance sheets globally was in gold, 74%. Today, that number is 20%. So that is a massive decline, okay, in the percentage allocation of central banks to gold. 74% in 1980, 20% today. As you say, at a time where risks are rising pretty dramatically, and arguably, and we'll get into this, that risks haven't been this high, arguably, since the Second World War.
Agreed.
So the signal that I think family offices need to be responding to is the fact that the emperor has no clothes. Okay? The emperor is being proven to have no clothes. And I'm talking about the US. And the Eastern central banks have worked this out. And there are two issues here. One, unsustainable debt, and we can get into that in the numbers. And it's secondly, the sanctions, okay, on Russia post the Ukraine invasion. And what that shows is that the US basically is prepared to steal anyone's money. So central banks, understandably, Eastern central banks are understandably replacing dollar assets with gold. And it's at this point, I think, Angelo, it's worth just remembering what the great historian Niall Ferguson said recently. He said that history shows that when any great nation finds itself in a situation where the interest on its debt is higher than its defense spending, then it doesn't stay great for very long. And that is the situation where the US is today. And I think that the bond market is working this out. I mean, who would have thought, if you'd come down from Mars and someone had said to you, look, you're going to have interest rates rising, gold is going to still do really well, because we all know that gold typically does better when interest rates are falling. Okay, it makes sense. But that hasn't happened this time. And so we have to ask ourselves the question, well, why is that? And I think the reason for that is that the bond market has worked out that the US has a real problem, that this debt, the fiscal deficit, 7% of GDP, 125% debt to GDP ratio, that this is becoming unsustainable. And I think, again, Eastern central banks can see it. They haven't had enough gold in their reserves. That is why they are buying it hard, whilst the West in the main still are not. Now, you could say to me, Angelo, you could say, yeah, Jonny, but come on. the debts have been high for a very, very long time. So what's different? What's different this time? And look, the truth is, I cannot tell you when this debt time bomb is going to blow. Nobody can. David Einhorn said earlier this year in an interview, he said, look, debts don't matter until they do. Until they do. And when they do, you've got to be protected. And that's the message that's got to come out from, hopefully, from this interview. And it's very interesting that the Eastern central banks are arming themselves. They're protecting themselves by getting away from the dollar, which is obviously devaluing at a rate of knots, fallen 98% versus gold since 1971, of course. And so family offices, I think, listening, need to heed this clear signal and reassess the scale of their US asset allocations, whether that's in public equities, whether it's in US treasuries, private equity, given the leverage in the system. And frankly, should just be listening a little bit to what Eastern central banks are saying and just follow what they're doing. Because at the moment, and you alluded to at the start, that most simply are not. And maybe just to finish off on this question, maybe the real signal that people should be listening to is Taylor Swift.
Because you'll have to explain this one, Jonny.
Because as I see that after the debate last night, that she's now backing Harris. Well,
I think that was to be expected.
I haven't seen any policy from Harris that's addressing the fiscal deficit. So if Taylor is now going to swing the US electorate to backing Harris for the White House later this year, then good luck to getting those fiscal deficits down and the debts down, because I don't see the policy.
Jonny, my next question relates to what you built up to, and that is, we know about Bretton Woods, we know about the dollar becoming the world reserve currency, 1944, but whoa, what really impacts our discussion today is the year of 1971 and President Nixon. And that is effectively coming off the gold standard that would then become the norm for other countries. And our currency is not backed by anything tangible. Now, I know there are going to be people that are going to say, well, look at our military, look at our planes, our boats, our naval force. I hear you, brother and sister, but this is a little different. The actual currency itself used to be backed by gold that had limited. You can't just print it on limited or mine it. Maybe it's what, a 2% a year. So henceforth, what was that historic day in that year of 1971 and the impact it had, looking now at what, 50 plus years later, on monetary policy, on fiscal responsibility, and to some degree, the mess that we're in now?
Yeah, look, I mean, 1971 is a key moment, right? That Nixon, when he collapsed the gold standard, what he said was that, don't worry about it, guys, right? Because the dollar is going to remain strong. That was a lie. The dollar has fallen 98% versus gold since 1971, okay? So it's had a massive implications, which all leads into this discussion. But if you think about what happened back then and why did he do it, right? You had the Vietnam War. Debts were increasing. The dollar was being attacked. Nixon had to do something, right? He had to stop gold from being exchanged for dollars. And obviously, when he did that, he had to make this promise that it was going to remain strong, which we know was wrong. But doesn't that all sound quite familiar to where we are today, right? You got wars, you got a weakening dollar. We've just talked about Eastern central banks that are repatriating assets away from the US, away from the dollar into gold, something that is a store of value over many centuries, millennia. And so the reality is that Nixon had to sacrifice the currency to save the broken system. And it's kind of interesting that we're seeing a similar narrative today. You know, someone I respect enormously, Russell Napier, just a great market commentator, and his theories on financial repression are very well understood. But for anyone that doesn't follow him closely, you know, when he thinks about financial repression and inflation, he basically says that, you know, inflation is stealing money from old people slowly, right? That's basically what it is. It's the practice of trying to keep borrowing rates, you know, below inflation rates, okay, in order to, you know, gradually inflate the debt away. And I see this parallel today completely. So look, back to your point, 1971 and what Nixon did is absolutely critical. It's had huge ramifications for currency markets, okay, frankly for all markets. And you can see now that having had this decline in the allocation to gold from central banks since 1980, having decreased from 74% to 20% today, central banks have woken up and smelled the coffin thinking, uh-oh, we've got a problem here, right? And that's why that 20% allocation to gold is going back up, and that's why gold has been strong at a time of rising interest rates. And again, we can talk about a little bit more about this and monetary policy, but the reality is that currency is only going to carry on weakening. And that's the position that we're in today.
How do you view the relationship between fiat currencies, which are backed by nothing, and effectively debasement, and gold's trajectory over the next decade, particular in economies that are highly levered and reliant on aggressive monetary policies?
Yeah. Look, I think the first thing I'd say is we shouldn't be assessing gold over 10 years. It needs to be assessed over 100 years. Okay, it's got to be viewed over a much longer time horizon. And history will tell you that, you know, history will inform us about what the future will look like. But the problem today, Angelo, is that a lot of people just don't study history closely enough. And it's just much easier and frankly more fun to extrapolate the good times that we see today in stock markets and to assume a continuation of that than actually think about, well, what is the maths telling us? And, you know, what is this debasement of currency that we are seeing shows us. And unfortunately, the maths of today and the facts about debt and inflation mean that, you know, history may not repeat itself, but it certainly rhymes. Mm-hmm. And what history shows us, it was Mark Twain that said that, wasn't it? What history shows us, and Voltaire said this, of course, in 1728, that currencies all return to their intrinsic value, which is zero. Think about it, right? Yeah. No currency anywhere in the world over the last 500 years has survived, right? It hasn't. I mean, just take the last 100 years, okay? And this is, you know, when I speak to family offices about this subject, I try to get it to the real world and make it easy to understand. And the best way that I get it clear in my own head is to think about it this way. In 1920, gold traded at $20 an ounce. So in 1920, 250 ounces of gold was worth $5,000. And in 1920, $5,000 bought you a 4-bedroom family home in middle America. Okay? Roll forward to today. $5,000 will barely pay the insurance on the home for a year, let alone buy a family house in America.
And by the way, my audience would understand this. That would be about the monthly insurance bill in California.
Okay. But if you held on to your 250 ounces of gold, that's what, $625,000 today. That buys you pretty much a 4-bedroom family home in middle America. May not be in LA or Malibu, but in middle America, that'll buy you a family home. So to me, that sums it all up. And I don't know whether this is myth or not, but they say that in Roman times, 1 ounce of gold bought you a toga. Well, they say, well, maybe 1 ounce of gold will buy you a Savile Row suit. Well, looking at your suit, Angelo, I think you probably need 1.5 ounces of gold. But
maybe 2, actually, Johnny. Come on.
you get my point that this just being this, that's kind of all you need to know about currency debasement. And then you come back to the point about where we are with the debts. What does that mean for the dollar? We've got wars going on. They've got to be funded, et cetera, et cetera, et cetera. And then you talk about, well, what does it mean about levered economies? And I think this is fascinating, right? Not just moving away from America for a second. Look, America basically needs to bring down interest rates, okay, in order to help corporate America that just has too much debt. Let's see what that does to inflation and whether that's going to be sustainable or not. My personal view is that I think stagflation is what's around the corner, but we may get interest rate cuts first, and let's see what that happens. But just take the UK example and the famous very, very short Truss government in 2022 and the famous budget with Kwasi Kwarteng. And in that budget, they announced these unfunded tax cuts. Now, we're all for growth, right? And you've got to get taxes down in order to stimulate growth. And the UK is a separate subject. We're terribly worried here about what's going to happen here with the budget on October the 30th. But just bear with me for a second. So in autumn 2022, the Conservative government, as it then was, announced these unfunded tax cuts. And look what happened to the bond market, right? Or the gilt market here in the UK. The bond market said, you guys can't afford this, right? You can't afford it. And the bond market sold off spectacularly quickly. Okay. And almost overnight, Angelo, the pension fund industry in the UK became insolvent with asset liability mismatches. Almost overnight. Liz Truss lasted, what did she last? Less than 2 months or something. I forget what it was. One of the shortest prime minister reigns in history. But this is a really interesting example about how the bond market will control, where interest rates are, okay, for mortgage holders in a levered economy where you simply can't afford to do that. And I think that is a classic example and a lesson for levered economies and how central banks can lose control of interest rates. And look, we haven't seen it yet with the US. We haven't seen it yet. But back to this point about how rates, bond yields have been rising at a time of the gold price has been rising at a time of interest rates rising in the US, and that's because I think the market is smelling something. The market is smelling that these debts are just unsustainable.
Given the long-standing debate over gold's role as inflation or deflation hedge, how do you see gold performing over a prolonged stagflation scenario, or even during what unfortunately could be rapid economic contraction?
Okay, so let's define stagflation. Stagflation is high inflation, it's high unemployment, and it's stagnant demand. And frankly, it's the worst scenario for risk assets. And I think, again, we've got to look back in history to the 1970s, where that was the last time that we had a proper stagflationary environment. Now, during that 1970s stagflationary period, gold vastly outperformed the stock market and became one of the best performing asset classes of the decade. And after the US abandoned the gold standard in 1971, gold prices rose from $35 an ounce to around $195 an ounce by 1974. And despite some volatility, they continued climbing to a peak of, what was it, $850 an ounce in January 1980, right? And I listened to your Rick Rule interview, and Rick Rule made the point that in his career he'd seen two mega bull markets in gold, and he talked about this one. That was a very, very long, protracted bull market in gold. Okay, but it was the stagflationary 70s. Now, in contrast, the stock market, and let's take the S&P 500, experienced massive volatility, very poor returns throughout the decade, particularly during the 1973, 1974 bear market.
Mm-hmm.
And the S&P lost about half its value. I think it was actually worse than the UK. And so when adjusted for inflation, gold provided substantial real returns, while the stock market's real returns were often negative due to the era's high inflation and poor economic growth. So I think that period, Angelo, underscores gold's role as a hedge against inflation, against economic instability, preserving wealth.
It does appear, and I don't mean to be a conspiracy theorist, but it does appear that the pricing of gold has been at times, my words, artificially suppressed by market mechanisms, whether we deem that to be the powers that be that influence derivative and future contracts. Therefore, there are times I expected gold to perform even better, and it hasn't. Why?
I'm not a conspiracy theorist, Angelo. Look, I think there's clear evidence there has been manipulation. I think there's clear evidence. I was actually looking the other day at something that the economist William White said back in 2005. Okay, now I forgive me my thoughts on dates. I might have got this wrong. Now, an eminent economist. He certainly worked at the BIS, the Bank of International Settlements, sure, at one point. And I've actually, seen a quote from him that talked about, and I quote, joint efforts to influence asset prices, especially gold and foreign exchange, in circumstances that might be useful, close quotes. I mean, that's pretty clear to me, right? And the BIS is the central bank of central banks.
Okay? Absolutely. They are the central bank, central banker. And in that masterclass that I referenced, trust me, they get some love, although some people may call it hate. I'm very familiar with it.
I mean, and then of course there's, Mervyn King, former governor of the Bank of England. And he himself, again, I forget the speech, but he himself admitted to joint coordination of selling gold in order to support currencies. Now, you've got to think about this. Well, why? Well, I think the reason why governments don't want the gold price to go up is because it reveals the mismanagement of the economy.
Mm-hmm.
Yeah, it's a mirror image of a mismanaged economy. If the gold price is doing well, and the currency is weakening. One other thing. Now, this is a little bit left field. So I'd say don't quote me, but I know there are people listening here. But there's been some pretty odd trading over the years, right? So we've seen, those that follow the gold markets very, very closely will kind of know this. It hasn't been recent, but some time ago, there were some very, very large sales of gold via futures contracts just after midnight European time in very, very liquid markets. Who's doing that? I don't know, but pretty odd trading. And the suspicion is that was Eastern central banks buying gold. This movement of the shift of power from west to east. And here's by the way, on this point, here's a really interesting stat again from Niall Ferguson. In the year 2000, the US had twice the manufacturing value add of China. 24 years later, China has twice the manufacturing value add of the US.
That's a shockingly short amount of time for that switch to occur.
It's an absolutely amazingly short space of time. And I think that, again, on the BRICS, we have to just think about supply and demand of gold. We have to think about the impact that this move is happening. Again, remember, 74% of global central banks' balance sheets to gold, now 20. That's only going one way. Is it going to go to 30, 40, 50? Why not? Who knows, right? But it's going to have a big impact. And the BRICS, because they're so resource rich, right? Russia, for instance, got $85 trillion of natural resources. If they carry on, buying gold, and there has been discussion about the BRIC countries backing their currencies with commodities, right, including gold. We need to think about this. What is that going to mean? And given all the natural resources that they've got, whereas the West, well, what have we got? We've got a lot of debt, and our assets are basically financial. And then it brings you on to, okay, so let's just walk this through. If the BRIC countries just carry on doing what they are doing, and we can debate what would make them stop, but it's hard to see at the moment. You've got to look at supply and demand. So there have been 200,000 tons of gold produced ever. And there are 3,000 tons of gold, new supply every year.
Which is what, about 2%?
Yeah, 1.5%.
Right.
Okay. And so, if this were to carry on, and we can see that this 1.5% is being very easily mopped up by ordinary demand. And so we have to think about, well, okay, is this going to be inflationary if, for instance, this carries on, or maybe their currencies are backed by commodities? I would say it's going to be very, very inflationary, right? And that leads on to the question: well, what happens? What happens after that? Because there just isn't the supply to satisfy that level of demand.
And that goes back to supply and demand, specifically when a given market infrastructure, which leads to an increase in price. And then I think we have to say to ourselves, okay, well, if that means that interest rates are going to rise further, and yet we've got this unsustainable debt burden that we can barely service, then what's going to be the impact on monetary policy
on that, well, surely what it's going to mean is going to be you could get a proper rout in the bond market. Faith in the US declines further in US assets. And that brings back more quantitative easing. And we keep hearing this phrase, QE to infinity. But I mean, if this were to happen, the BRIC countries keep on buying gold and back their currencies with gold or commodities, then that can lead to further QE, more buying of bonds. And what does that do? It devalues the dollar even further. And then take it to the final point. Well, what's that going to do to gold? It's only going to go up. And Angelo, this is before the institutions have woken up to allocating enough to the asset class. All right. I mean, I spent 27 years in the City of London, 23 years at Morgan Stanley, talking to institutions. I mean, they are just not in gold. I mean, I'm generalizing, but they just don't own it. I've been to big wealth managers here in London to talk to them this year about gold. One said to me, "Look, we sold all our gold in 2014. We don't have a solution for this." That's where we are. So again, come back to that supply-demand point. If that demand is going to be satisfied, it can only be satisfied at much, much higher prices, and that's before institutions,
Exactly.
family offices have increased their allocations to gold.
What are the critical risks? And I talk to my audience, my members, my consulting relationships all the time about owning physical gold. Do I think they should have some gold coins and arguably bars in their home in a secret location? Probably. But owning future contracts, owning ETFs, you're getting kind of the market exposure, but you're really owning gold as a hedge against risk, and it needs to be actual physical. So you answered the question, I suppose, in Von Greyerz, in what they do in Switzerland, of all places, in a very secure, quote unquote, facility outside of the banking system for the reasons that you noted that I've been talking about for years. And maybe that's why some banks hate me. So talk a little bit more, I suppose you could say. If I want to buy a real amount of gold, do I want to have it stored outside the banking system? Maybe even more specifically, why Switzerland, and what counterparty risk, I guess not banking, do I have to be concerned about?
Well, look, as I just said, if you owned your gold in Credit Suisse a few years ago, you probably thought that's okay. As the share price kept going down, you were probably thinking, do I really want my gold in Credit Suisse? Who would have seen Silicon Valley Bank going bust? And look, it goes back to so much of what we've talked about what's happening in the world. When rates rise, things break.
Yeah.
And counterparty risk was just never a thing until Lehman. And then it became a thing. And then with the printing of money that we've talked about, and the incredible wealth creation since then, the reality is it was only when Credit Suisse went, Silicon Valley Bank went first, of course, didn't it? Over those few days, and there was this rippling effect, and it was like 2008 was happening all over again. And so, to your question, if you want to own gold, given the risks that we've talked about at length, why on earth would you own it in a bank? Think about it. You own it in that bank, and China invades Taiwan. The Middle East, terrible situation with the war, intensifies with Iran. NATO gets dragged in further with Russia and the Ukraine war. Or the debt time bomb just goes off. Would you be happy owning your gold in a bank, a levered business, when you can own it outside the banking system in your own name, and you're the only person that has access to it and a legal claim to it. So that's my point. And, that's why you've got to own it physically, because thousands of years, the history that we've talked about, it's the history that shows us that it's physical gold that is the form of wealth protection, the store of value. Gold ETFs, look, this is a long debate, but the reality is there's plenty of people out there that say that these gold ETFs just aren't physically backed by the gold.
Right.
There isn't the gold that physically backs it. And where's the gold? Sitting in a bank. So and we can talk about mining shares or whatever, but at the end of the day, the purest form of wealth protection and wealth preservation is physical gold outside the banking system with the best insurance, eliminating all counterparty risk. And that was Egon's vision.
Gold were to reach $5,000 an ounce. What specific macroeconomic and geopolitical conditions would the world need to be for that to happen? I'm assuming pretty darn bad, but you gave some examples of where things are looking bad and getting worse. So those conditions could happen.
Look, I mentioned three of them just now, right?
Right.
China, Taiwan, Middle East escalation, and the Ukraine war. It could be another bank going bust, right? It could be something. It could be, central banks losing control of interest rates. Any number of things. I mean, look, I can't forecast that, but you talked about 5,000 in the next decade. I would say 2 to 3 years.
Right.
I mean, seriously, and again, perhaps now is the time to talk about the ownership point, right? I mean, if this momentum that we see, I think that we are still in the very, very early stages of a long multi-year bull market in gold. It is absolutely not too late. I mean, what Egon says to all the employees at von Greyerz is, look, he says, look, I've been in this business for 25 years, but it's only just starting now. And I think that it could be any of those geopolitical risks, but on the ownership point, just before leaving Morgan Stanley and joining von Greyerz, I wanted to do some homework. So I read 5 or 6 big family office reports from, the great and the good. Yeah, so Goldman Sachs, JP Morgan, UBS, KKR, BlackRock, and UBS. So 6 great institutions. And then I looked at the asset allocation that they saw within the family offices that they were surveying. They looked at the asset allocation models. Only one of those 6 reports even mentioned gold, and that was UBS, as you'd expect, right? A Swiss institution. Only one even mentioned it, which I just thought was incredible. Roll forward to today, and in anticipation of this interview, I read the Citibank report. Anyone can read it. This is the most up to date to the end of June of this year, and they surveyed 1,200 single family offices, and they show the asset allocation, and I was staggered to see that only 0.7% of that enormous pool of capital is allocated to commodities. That's all commodities. So think about that, right? So let's be generous and say that 0.5% is to gold, and that could be ETFs, probably, right? Or gold mining shares, or whatever. Let alone physical gold held outside the banking system. And that's why it's a long-winded answer to your question. 5,000? What about 15,000? because there isn't the supply. Think about it. When was the last big mine find of gold? Back in the 90s. It's getting harder and harder to get this stuff out of the ground. And back to our point, only Eastern central banks are buying. So my point is that if this thing starts to move as we think it will, slowly but surely, family offices come in, pension funds, institutions, along with central banks, don't forget at 20%, it's going to go up. It's only going one way. It's not going down. It's only going up. It was 74% in 1980 of central banks' balance sheets in gold. 5,000, come on. That's within 2 to 3 years.
Working from the perspective of how the world is now, looking at history and what could go wrong, it needs to be greater than under 1%.
Look, 0.5% of world financial assets today are in gold. In the 60s, it was 5%.
Yep.
So just think about that, right? Just getting back to the mean of 2% is a quadrupling of demand that can only be satisfied by a lot higher prices. And look, I want to make this point really, really clear, right? Nothing goes up in a straight line, right? Gold is a lot less volatile than Bitcoin that you talk about clearly. And look, I personally think that they're entirely different asset classes. Bitcoin's been around 15 years. Gold's been around thousands of years. I think they are more complementary than anything else, but it's not one or other, but you just got to get your sizing right. All I would say with gold is, I've read academic research suggesting that the right amount of gold within an asset allocation model is 19%. Certainly at Von Greyerz, we've got hundreds of clients and a lot own more than 20% in gold, but we would say, look, 20% is probably the right number. However, I can totally understand why, family offices say, look, 10%, that's going to be my insurance. That's my insurance policy, 10%, and I'm going to own it the right way, okay? But what did I just say about where we are? In the Citibank report, we're 0.5%. Just only going from 0.5 to 3 could have a big impact on the price. But you pay as your money, you take your choice. Some people say 10, some people say 20, whatever. Look, for me, it would be 20%. Now, given the risk that I see in the world. Now, look, if Treasury yields get a 15%, we're going to have a separate conversation, right?
Of course,
we got to go where the puck is going, not looking backwards, right? And if we get to a point where treasuries are yielding 15%, well, we'll have a separate conversation where you want to be selling your gold at 20,000 and buying treasuries, right? But as I do meetings, I just don't think people have enough hard assets. If we're in for a stagflationary environment that's looking more and more likely. But the problem is let's look at history. Oil in the last 3 recessions in 2002, 2008, 2020, COVID. Oil fell peak to trough 60%. Right? And clearly there are the variables there with what's going on in the Middle East. There could be an oil shock, and it's complicated, right? But it's highly, highly cyclical. Real estate, right? Look what happened with the subprime crisis. Look at the leverage in that market, and that's
a lot.
That's where rates are today at 5. Well, what happens if rates go to 6, 7, 8? We know what happens in that situation, right? Values fall a lot. So again, I think hard assets will do well in the environment that I see, but you've got to size it right. And real estate, I don't know so much about farmland, but certainly real estate and oil are completely different kettles of fish versus gold in terms of proper wealth preservation.
And Jonny, I believe my last question before we get to a close. In the context of gold mining investments, do you see gold miners providing a superior risk-adjusted return if you're looking at it strictly from a return perspective compared to physical gold? And should investors weigh operational risk against the potential outsized gains?
I think it's a very timely question. Because gold mining shares, as you know, have done terribly badly for many, many years versus the gold price. Okay. And I think, look, within the stock market, I can see why precious metals mining shares finally actually could do quite well relative to the S&P. Okay, I can certainly see money coming out of the Magnificent Seven. We don't need to get into the narrowness of that market and some of the valuations that we see, right? But you know, you can see why money might be coming out or could come out, certainly in the environment that we're talking about, out of some of these other parts of the market to come to a very, very unloved part of the stock market, which is the mining shares. Only yesterday, you saw that Anglo Gold Ashanti bought Sentiment at a 36% premium, right? Or put a bid in at a 36% premium. Mm-hmm. That may not be enough, but I wouldn't be surprised when you think about the all-in cash costs for a gold mining company today at $1,900 an ounce, 2,500, you know, on the screen today. There's some pretty nice margins there, and you know, I can see that. I can see more consolidation. The timing feels right for more consolidation in that market, but that is investing and speculating, I would suggest, versus proper wealth preservation, which is physical gold outside the banking system. They're different. Okay, let's think about how the stock market has evolved over the last, certainly in my 30-year career in the city. The rise of passive money versus active. Okay, I think I'm right in saying that over half of all money in the stock market now is passive money. What does that mean? It's great on the way up for the Magnificent Seven, when that passive money just has to keep chasing it irrespective of the price. But what happens when the bear market comes and that passive money has to sell? It may be, and this would be my bet, it may be that precious metals mining shares outperform a falling stock market big time. Big time. But you got a lot of risk there, and it's a different investment to physical gold outside the banking system, which in our view is the only way really for wealth preservation for the longer term. Absolutely. Well, look, you know, thank you so much, Angelo, for giving me this platform and a really interesting discussion. I hope that the listeners have enjoyed it too and perhaps learned something. Look, for any questions or any inquiries about Von Greyerz and what we do and how we can help you, please just email me. My email address is jh@vg.gold. I'll answer any questions. I answer every single email that I get. So please get in touch, and we'd love to talk to you about helping you protect your wealth.